The seat count collapse. Salesforce seat counts dropped 14% this quarter, marking the definitive end of the per-user subscription era. This isn't a seasonal dip or a macro headwind. It is a structural rejection of the model that built the modern cloud. When enterprise software revenue is tethered to human headcount, and that headcount is being systematically replaced by autonomous agents, the math for Silicon Valley stops working. Investors who spent a decade valuing companies on a multiple of recurring seats are now staring at a terminal decline in their core metric. And the math of agentic displacement is even more brutal than the headlines suggest. The math of agentic displacement. In the old world, a 500-person sales team meant 500 licenses for your CRM, your internal chat, and your HR stack. In 2026, those same firms are using agentic workflows to do the volume of 500 people with a staff of 50. For a SaaS vendor, that is a 90% wipeout of the account's value under the legacy per-seat model. Klarna's recent move to replace thousands of support seats with proprietary AI agents was the first crack in the dam. Now, every Fortune 500 CFO is auditing their software stack not for utility, but for the number of unnecessary humans it currently charges for. This revenue hole is forcing a desperate pivot to the outcome-based model, the consumption trap. Outcome-based pricing, where you pay per lead generated or per ticket closed, is being sold as a win-win for alignment. In reality, it is a volatility nightmare for software companies. Wall Street pays a premium for the predictability of subscriptions. When you shift to consumption, you shift to the same cyclical risk as a commodity provider. ServiceNow and Zendesk are attempting to frame this as value alignment, but the P&L shows they are simply losing the power to monetize human presence. This brings us to the massive shift in how companies actually allocate their capital. The CAPEX cannibalization. The hidden reality of 2026 is that software budgets are being cannibalized by compute requirements. Every dollar a firm saves by cutting Slack or Microsoft 365 seats is being redirected into the private GPU clusters needed to run their custom agents. We are seeing a massive rotation from software operating expenses into infrastructure capital expenditures. The software layer is becoming a thin, low-margin wrapper around the actual intelligence, and the wrappers are getting squeezed from both sides. This isn't an evolution. It is a liquidation of the traditional SaaS premium. The real implication. The transition from per-seat to outcome-based pricing represents a fundamental re-rating of the entire technology sector from growth to utility. The seat count decline we discussed earlier is not a temporary glitch, but the result of the software finally delivering the productivity it promised, which ironically destroys its own pricing power. By linking revenue to outcomes rather than headcount, SaaS companies are admitting they can no longer capture the middleman tax on human labor. For investors, this means the era of 20x revenue multiples is over. If a company cannot prove it owns the underlying model or the exclusive data moat, it will be valued like a power company. For operators, the task is no longer managing a seat budget, but managing an inference budget, which is far more technical and far less forgiving. The era of growth through hiring is dead, replaced by a race to the bottom on cost per task. Watch Microsoft's next quarterly filing for the removal of the commercial seats metric. That will be the official signal that the subscription era has been buried for good. Subscribe for more.